All right. So what we're going to look at now is the recording process. And the way the recording process works is that we do not post directly to the ledger cards. We post to a journal, okay? And I'm going to kind of, what is a journal? A journal is a list of transactions, right? A list of transactions that happen. It's, it's, if you have a personal journal or whatever, the accounting transactions that occur, okay? Now, I am going to share something with you, and it's going to seem kind of weird. This is my computer right here. I'm going to share something with you that is going to seem strange, but this is the reason why we do a journal and we don't go directly to the ledger cards. Remember the T account, we have a ledger card or a T account for every account. Cash has one, accounts receivable has one, liabilities have one, right? They all have one. So we're going to pretend for a minute. Let's just pretend that these are all my ledger cards for my account, right? These are all my ledger cards. I've got one for cash. I've got one for accounts receivable. I've got one for supplies. I've got one for inventory. Then I've got my expenses. So it goes through all the different accounts. So these are all my ledger accounts, right? And this would be nothing compared to what a real company is. When I went to work for a company in 1992 and my job was to computerize the entire accounting system, they had 3 books. I can't see my camera here. This thick, 3 books full of ledger cards. Well, 2 of them were ledger cards. One was report stuff. So, okay, so we're going to pretend like a bunch of stuff just came in the mail, right? So a bunch of stuff just came in the mail. We're going to say, okay, these are my ledger cards here, and now I've got stuff came in the mail. Okay, so I have a bill. We're going to pretend like this is a bill. Oh, I have a bill here, and it's for utilities expense, right? So if I was to post directly to my ledger cards, this is what would happen. I would go through and I would find my utilities expense, right? And I would say, okay, $500. I would debit utilities expense $500. Then I would say, okay, well, what do I have to credit? Oh, I have to credit utilities payable because I'm not paying it yet. So then I'd go through and I'd find the utilities card, right? And I'd say utilities, I'd say $500 bill or whatever I said it was, 200, 500, right? Put that in. Okay. So then this bill would be done. I would put this bill over here, right? And I would look at the next thing. And what you would do is you would like batch all your bills together and then you would do all your payroll together and things like that. Okay, so now I'm doing payroll. Okay, so here's a time card for Sam Smith, right? So I'm going to debit salaries and wages expense $100. I'm going to credit salaries and wages payable $100. Okay, I'm done with this. The payroll, I'm done with payroll and put it over here, right? Okay, so everything's going along great, right? You're posting. And then your boss calls you and you leave your office. So you leave your office, and the last card you left off, well, it was right here. This is your last ledger card. Okay, we're pretending this is a ledger card. So you go to the other room, and while you're gone, somebody comes in your office and they're like, oh gosh, I need Penny to pay this bill right away. This bill has got to be paid right away. Where am I going to put it so she'll see it? I know. I will put it right on top of all her paperwork right here. And then they leave, and you come back and you're like, oh my goodness. They have just put all my stuff in a pile, and I have no clue where I left off. So you would have to go through every single ledger card and back through every single invoice, time card, bill, everything in order to figure out where you left off, in order to know where you left off. Now, it doesn't necessarily have to be a person walking in and moving things on your desk. You could open a window and it could blow everything off your desk. You could pick something up and move something and forget where you put it. You could get on a phone call and lose track. You could spill coffee on your desk. There's a million things that can happen, all right? So what happens, instead of going to each card and putting the information in each card, you put all of the information on a journal. You would write it on the journal. You would debit equipment. You would credit notes payable. You would put it all on a journal first. So that way, if you're halfway through your entries and someone comes and piles all your papers up on your desk, or you spill things or you lose your track, you just go back to the journal and you go, where did I leave off? Oh, the last thing I did was this. okay? So it goes in the journal first, and then from the journal, once you're done with the journal, then you take the journal and you post those to the ledger accounts. You move them over to the T accounts. And then you do a process of checking it off. So if you look at the first transaction, you move it to the T account, you see it's a debit to equipment, you go to your T accounts, you go through, you find equipment, you debit equipment, credit to notes payable, you go through, you find credit notes payable, and then on your journal, you put a check mark that that's done. So what happens now is if you lose track, you go back to your journal, oh, the last thing I posted was this one. You know exactly where you are. So that's kind of a crude example of the way or why, some of the reasons why we want to use a journal, but those are things that I've personally experienced in the workplace doing accounting that show me why a journal is so important. Okay. So I know that's kind of silly, but that's what I'm using as my example. So, the rules for the recording the process. So we analyze the business transactions and then we journalize the transactions. We enter them into a journal. Now, in this class, we will use one journal. It will be a journal. In the real world, you have an accounts payable journal. You have an accounts receivable journal. You have an adjusting entries journal. You have a general journal. So you have journals for different things. When you first learn accounting, though, we just use one journal to kind of keep things as clear as we can. Now, the next step after that is you transfer it, like I said, to the ledger cards. And that's what we'll be looking at when we come back to class on Monday. So I teach a combination of analyzing the transaction and journalizing together, okay? So we'll go through that process. So let's go to the next slide. So this is just kind of saying here, you analyze the business transaction. So you're looking at what it is you're getting. Is it an employee time card? Is it an invoice? Is it a note for a loan? What is it that you're getting? You figure it out, and then you journalize it. You put it into the journal, and then you post it to the T account, okay? Now, this little picture they're showing right here of this invoice or this journal or these T accounts, those are what they call they call this right here, the invoice, the source document. So that would be the document that you got in the mail, right? What you got in the mail that tells you, you have a bill to pay, or the time card you got. Everything that you get in this class you will not get any source documents. Everything will come in a paragraph, a description or a chart or a graph or something. Okay, all of your source documents will be written out for you versus you actually looking at the invoice. Okay, this is just giving you an example of this is a source document. Here's an invoice for equipment that was purchased. This is showing you the journal entry here where they're going to debit cash or debit equipment and credit cash because they paid cash for it. And then this is showing you the entry moving over to the T accounts. Okay, the October 2nd is the $5,000 entry. Okay. So again, we're just doing the overview here. Don't get too tied up in this yet. All right. So they call the journal the Book of Original Entry. I talked to you about the reason why one of the main reasons why we do the journal. It is done in chronological order, so you do it in date order from the oldest to the newest. And I think everything you get in this class is already in that order. It's not only helps you to keep track of where you are, but it also helps you to locate errors too. So instead of having to go through every single T account, if things don't balance at the end of the period, you can go to your journal first and begin to analyze that to see where there might be a mistake before you have to dive into the T account cards. So we're going to do an example here of the journalizing, and I'm going to kind of describe to you the method that I use to teach it and the method that I have found in all my years of teaching this since 1999 that works the best for people, okay? All right, so we are going to be looking at Sierra Corporation, and it says October 1, Sierra issued common stock in exchange for cash. October 1, Sierra borrowed $5,000 by signing a note. And October 2, Sierra purchased equipment for $5,000. All right. First question you always ask yourself is, who am I? And you are always going to be the company. Later on in the class, you might be the buyer, you might be the seller, and that's going to be important. But who are you? You are the company, so you are Sierra Corporation. And that's how you're going to start this out. You are Sierra Corporation. And now you're going to ask yourself a series of questions. Okay? So don't pay attention to that part that has the red line through it. So October 1, Sierra issued common stock in exchange for $10,000 cash. So what did I get? What did I get? Well, I got cash. They told me I got $10,000 cash, right? I'm Sierra Corporation. I got $10,000 cash. What is cash? Cash is an asset. What kind of balance does an asset have? Assets have a debit balance. So in order to make it go up, I have to debit cash. Here's another rule I forgot to mention. You always do debits before credits. You always do debits before credits. Okay, so we put October 1, where the count is cash, and we are going to debit $10,000. Okay, so then you're like, okay, I got that part. Now, what's the other part? Well, I know it's common stock. So what did I get? Well, I got an increase in the common stock. So now I have more common stockholders. So common stock has what kind of a balance? It has a credit balance. So in order to make common stock go up, I am going to credit the common stock account. So we put common stock, and then we put 10,000 under the credit. So we've done rule number 1, which is debits before credits, all right? And rule number 2, the debits and the credits equal. We've got a $10,000 debit and a $10,000 credit, okay? So that's the first entry. Now we're going to go look at the second entry, and we're still Sierra Corporation, right? Sierra Corporation. So we're going to go here. On October 1, Sierra borrowed $5,000 by signing a note. Okay, so what did we get? Well, we got $5,000 in cash, right? So cash is an asset. Assets have a debit balance. So to make them go up, we're going to debit them. So October 1, we are going to, the account is going to be cash. We're going to debit the account $5,000. What else did we get? Well, we borrowed it and we signed a note. So now we're liable to pay it. So we got and it tells us it's a note. So we got a notes payable. Notes payable is a liability. Liabilities have a credit balance. So in order to make that go up, we're going to credit it. So we're going to put notes payable and credit it $5,000. Okay. Now we're going to look at the next one. And let's see. October 2nd, Sierra purchased equipment for $5,000. Now, if they don't tell you that that you got a loan or anything, then normally it would say paid cash, okay? But if they don't tell you, then you assume that it's cash. Okay, but this one says purchase equipment for cash up above, all right? So who are we? We're Sierra Corporation. What did we get? We got equipment, right? We purchased equipment. And equipment is what kind of an account? It's an asset. So in order to make it go up, we need to debit the asset equipment. So October 2nd, equipment, we're going to debit the asset $5,000. Okay, now, anytime it says pays or paid, or anytime you pay cash, your cash is going down, okay? Anytime you're being paid cash, your cash is going up. So anytime it says pays or paid, the cash account is involved on some level. So in this case, we paid $5,000, right? We purchased equipment, that means we paid $5,000. So cash is an asset. Assets have a debit balance. In order to make a debit balance account go down, we have to do the opposite of what the normal balance is. We have to credit it. So we have cash. We're going to credit cash $5,000. Okay. So our cash went down. That's the other thing we got, or that's the other part of the transaction, is that cash went down. Okay. All right, now this is showing you just kind of a little example here of the transactions. I'll get your question one second. The transactions, and you're going to see here in red that it shows the descriptions. Now, in the real world, you would have descriptions for all of your entries. But in this class, we do not use descriptions. And the reason why we don't use descriptions is because the Wiley Plus gives you automatic feedback, right? And if somebody wrote issued stock for cash, they would get credit for it. But if somebody put sold stock for cash, they wouldn't get credit because Wiley has, you have to match it exactly to be correct, right? So we do not put any descriptions. So while in the real world, you would have descriptions for every entry, you will not have descriptions for any of your entries in this process, okay? So that's kind of information on it, and then we're gonna do some sample problems.